Silver is a market that broke out significantly and could run now. If you're short and you want to cover shorts or you want to keep things calm, you do what happened yesterday. Yesterday meaning last night for American traders. I mean, that's what's going on, right? Whether you want to call it manipulation or just a market that's susceptible to influence. That's what's going on.
Silver prices surged by more than 5% on Monday, marking a strong rally driven by investors re-entering the market after a period of risk aversion. The bullish momentum pushed the silver-to-dollar ratio to trade as high as $34.65, renewed investor appetite for the gray metal amid evolving macroeconomic dynamics and technical breakout patterns. Silver eased 0.52% on Tuesday but remained steady near $34.50, showing resilience after briefly dipping below $34 in response to the release of upbeat U.S. data. Buyers quickly returned, keeping the metal near weekly highs. The narrowing consolidation range signals a likely breakout. A move above $34.79 could target the March high of $35.80, while a rejection may lead to a pullback toward the key Fibonacci support levels of $33.99. Veteran analyst VinceLanci suspects recent silver price moves may be influenced by speculative or manipulative behavior. He argues that when silver shows breakout potential, large short-positioned players often act to suppress momentum by targeting weak links, such as European mining stocks. Lanci highlights last week's sell-off, triggered by weak Chinese PMI data, as a coordinated effort to dampen sentiment despite stable Chinese equities, calling it an attempt to paint the tape and sway market perception. From a technical perspective, Monday's price action represented a clear bullish breakout on the daily chart, giving bulls the upper hand in the short term. July silver futures have now established a firm technical advantage. The bullish target remains a close above $35.80, while bears will need to drive the price below last week's low of $32.80 to regain control. As the market consolidates just below key resistance, the tightening trading range implies that volatility could return sharply shortly. Traders and investors should monitor for a confirmed break above $34.79 or below $33.79 to gauge the next decisive move. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop.
Why did silver get slammed? This is, the last night. Okay, just as a background, this is a chart, a weekly chart of silver going back forever. And in 2021, when the silver squeeze was aborted, it happened during European hours when JP Morgan downgraded the silver mining sector, and that caused silver prices, along with European miners, to slide from an 8-year high. Okay? So just put that. Last night, China's PMIs came out and they were very weak. That's recessionary, deflationary, and calls for more, let's call it, calls for more stimulus on their part. So you would think that if silver sold off, their stock market would sell off as well because economic stuff, silver demand, but that didn't happen. Here's what did happen. During European hours, I'm going to put this chart up to give you some perspective. During European hours, silver it started during Asia, but during European hours, European mining stocks got destroyed. And those European mining stocks got destroyed ostensibly because China's PMI was weaker. What I'm saying here is, on weakness in Chinese economic data, the world mysteriously decided to sell European mining stocks and Shanghai futures, painting the tape in a very bad light. Now, the chart you're looking at there is an hourly chart for PIC. That's the Global Select Metals and Mining Producers Fund. Remember what happened in 2021. Silver has a 4% rally during U.S. hours, and PMI comes in a little weak in China, and European miners get destroyed. Let's go through the markets that were affected by this PMI. Here's an hourly chart for this ETF. It closed at 37.15 after gapping higher yesterday. And now it's going to gap in down here. So global mining stocks got slammed last night. Let's go company by company. Here's Vail. Vail, hourly chart, gapped higher and finished strong. Today, it's called down. Rio's been open all night. This is Rio yesterday, Friday, Monday, gaps higher, and then works its way lower. It's hard to see on that chart, but you're going to have to trust me on this. BHP is a little bit easier to see. BHP, hourly chart, Monday, gaps higher, and then the data comes out, and miners take it on the chin. How does that happen? How is it that a soft PMI number decimates European miners while Shanghai is getting sold hard? Well, the answer is, I think, this is completely speculative, I think somebody got nervous again. And I think if you're looking to keep a lid on an exciting market or a market that's potentially about to get exciting, you would pull the European miner card out. A little bit of weak data comes out on China, and you hit those miners. Simultaneously, in Shanghai, if they don't buy it, you sell silver. Anyway, admittedly, this is aggressive on my part, but I have seen so many of these things before. If it works, they do it again and again and again. So the buying in silver was US hours yesterday, mostly. Okay, and that was because American CTAs are weak and covered their shorts. A little bit of China weakness, and opportunists sit on silver and gold as well, but silver. There's no reason for silver to be this low, given the data and the events that came out, especially in light of China stocks not being lower. That's the Hang Seng, but you get my point. Anyway, a little bit convoluted. What I'm saying is silver is a market that broke out significantly and could run now. If you're short and you want to cover shorts or you want to keep things calm, you do what happened yesterday. Yesterday meaning last night for American traders. Anyway, I mean that's what's going on, right? Whether you want to call it manipulation or just a market that's susceptible to influence. That's what's going on.
Despite official data showing no mass liquidation of U.S. treasuries, analyst VinceLanci argues that a more nuanced shift is underway. Countries and institutions are increasingly hedging against dollar risk. According to Lanci, this indicates a broader strategy in which the dollar will be sacrificed to save treasuries. In other words, the U.S. may allow its currency to weaken to maintain demand for its debt securities, which continue to underpin the global financial system. Recent data from the U.S. Treasury Department supports signs of this shift. As of the end of February, China held $784.3 billion in U.S. treasuries. However, Beijing has been steadily reducing its holdings, reportedly offloading around $150 billion in 2024 alone. This forms part of a larger pattern among emerging economies, especially those in the BRICS bloc. Reports suggest that BRICS nations are considering withdrawing up to $7.5 trillion in assets from the United States. The motivation behind this move lies in a strategic pivot toward diversification, with gold becoming the preferred reserve asset due to its political neutrality and historical role as a store of value. As a result, gold is being favored over dollar-denominated assets, reflecting a growing distrust in the long-term stability of the U.S. dollar. If this trend of de-dollarization and diversification continues, it could pose a significant challenge to the United States' central role in the international monetary system. A weakened dollar might offer temporary support to U.S. treasuries by boosting their relative appeal. But it also risks undermining confidence in America's financial dominance. As nations recalibrate their reserve strategies, the implications for global capital flows and assets such as gold and silver could be profound. Let's get back to the interview.
10-year yields are 441, down 3. The dollar is 99.06, up 35. S&P 500 is 59.27, down 11. The VIX is 18.52, up a little bit. Gold is 33.58, down 23. Not on its lows, but certainly not on its highs. Silver 34.29, down 45, clawing well off its lows, but obviously still down. Copper 474, down 6, down one and almost 1 1/3. Oil up 12, natural gas 343, down 5, Bitcoin down 500, platinum palladium mixed, equally mixed. Gold silver stabilizing at 98 now. A little bit of correction there. And grains are all up. You can see that. Okay, here we go. 2 topics. The first topic is the analysis by a bank called SEB. I'm not going to do them an injustice by trying to pronounce their name, but SEB is a leading financial services group in Northern Europe, Scandinavian bank. They do a lot of grains. A lot of their client base is corporate and grains on the commodity side, and they're very energy oriented because of the grains. They published an interesting, if aggressive, comment on gold versus treasuries. Here's that analysis broken down with their original comments attached. That's the story there. Sorry, I'm just quoting myself. Bottom line is the bank feels gold buyers at 32.89 are treating treasuries as junk, assets that are only worth holding if nominal yields rise north of 10.2%. Really aggressive. But certainly not a random way to coordinate gold versus bonds. There's the post itself we just sent out. The broader implication is that the traditional roles of gold and treasuries in the global monetary system are reversing. That's not new to you if you're a gold fix reader since 2022. However, it is new to see banks start talking about it this way. Where treasuries once offered safety and liquidity, they now carry conditions. Where once gold offered no yield, it now offers freedom from political intervention. Their original commentary at bottom. That's part of a bigger report, a monthly commodity analysis. The only caveat, I mean, we agree with everything they're saying there. We can't say that 10.2% is the real nominal yield, that the nominal yield that has to make gold stop rallying. But everything they say is pretty sound. The other comment is, again, for the Tom Luongo people, we're looking at another European bank telling you treasuries suck. Fortunately for us, they're saying gold is great, but another European bank is saying treasuries suck. Now, hype and propaganda going all the way back to the worst case scenario stuff for bonds. But there's a lot of indication that the world may not be selling as much treasuries as they would have you believe, but they're hedging dollar risk significantly. And so the dollar will be the sacrificial lamb to save treasuries going forward. That's been our opinion for a while, and it's starting to come to fruition now. Before we get into the silver thing this week, the end of the COMEX era, post-COVID world and how everything changed, and Bank of America says silver will go to $40 before gold to $4,000. All right, related posts. Goldman, buy gold, not bonds.
Silver's recent price surge underscores a growing shift in investor sentiment amid complex global financial undercurrents. As the metal tests critical resistance levels, its resilience signals underlying demand in a market increasingly shaped by geopolitical tensions, reserve realignments, and strategic hedging against currency instability. Meanwhile, the quiet retreat from dollar-linked assets by major economies reflects a more profound realignment in global capital strategies, with precious metals emerging as trusted alternatives. These evolving dynamics hint at a broader transformation in how nations and institutions approach value preservation in uncertain times. Is this renewed confidence in silver and strategic rebalancing away from dollar-based reserves setting the stage for a long-term structural change in global financial leadership? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.